and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And this episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing ETF shop democratizing access to the most sophisticated alternative strategies. With diversifying strategies like market-neutral equity long-short, managed futures, and multi-strat quant, Simplify has a suite of compelling tools to help address the biggest concerns with the classic 60/40 portfolio. Check out their website at simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. So first, a sip of coffee. Did you miss me? You know, the last podcast before this one was the monthly CPI report for last month, which was the July report in August, and this is the August report in September. And then I didn't do any more podcasts for the rest of the month, and it really wasn't because of a lack of ideas, but it really was because, you know, it seems like every year August gets slower and slower and slower, and I. Over the last year or two, I've almost stopped trying. In August, it seems like everybody's away. It seems like people don't read blogs as much. They don't listen to podcasts as much, and that's a good thing. You should. If you're on vacation, you probably shouldn't be listening to this or reading this stuff. But I need a vacation too, and so I took a little vacation off from the podcast and a little bit of the writing. I did write one or two blog posts, and one of them, in fact, that is sort of relevant to today and to what we're going to be talking about with respect to the inflation report, is sort of the last one I posted, which is called "The Fate of Fate Was Fated," and that's FAIT in the middle there, which is flexible average inflation targeting. It was the Fed's framework up until just a month ago or so, or even a couple of weeks, and we'll talk about it in a little bit. But and that's an important blog post. It's linked in the show notes, and you really should take a look at it because it sort of does change how the Fed looks at inflation reports and to what degree they care about it. And really, we went through a period, in 2020 and in 2021, of course, the Fed said, no, there's not really going to be any inflation. And then it happened. They said it's going to be transitory. And we're still sitting here with median inflation at 3.6%. And they finally abandoned the idea that it was transitory. But they also, because with this most recent framework change, have abandoned whether they care. And it's not a whole lot more complex than that. And maybe I'll just describe this up front. So the Fed's operating framework for many years, for the last 5 years anyway, has been flexible average inflation targeting, or average inflation targeting, where they said that, well, inflation, because it was below target for a while, we can let it run a little bit hot relative to the 2% target for a while, and vice versa. If it's a little hot, then we'll need to push it down below 2% for a while, so that on average we're at 2%. But if we get to 2.5%, we're not necessarily going to be pushing it down to 2. If we get to 1.5%, we're not necessarily going to immediately push it back to 2. We're going to just aim over time, and so a little bit less urgency pushing it back to target. Well, Powell came out a couple of weeks ago at Jackson Hole and said he literally said that the makeup part of the average inflation targeting regime, we've surrendered. So we're no longer going to try to make it up when we miss. Now, if you're not going to try to make up misses to the target, then what the hell does the target mean? It really doesn't mean anything. And in this framework, they basically said, yeah, we'd like to have inflation at 2%, but if employment is weak, we're going to, emphasize, we're going to react to employment, even recognizing that means inflation will run hot. And if inflation runs hot, we're not going to later push it back. We're just gonna, so it's really sort of crazy. It basically goes full circle from back in the late 80s under Greenspan, when Greenspan said, hey, the first thing is to get inflation at target. And if we do that and we keep inflation low and stable, then that's the best long run outcome for employment, is in an economic environment that way. And for all I hate things that Greenspan did and some of the dumb things he did, he was absolutely right on that. We had, sort of a golden age of employment growth, partly because of that. And now we've gone exactly 180 degrees the other way around, which is that we don't care about inflation really at all. We only care about employment. And what we know historically is that if the Fed only cares about employment, what they'll get is not as much employment and lots more inflation. That's just the way it's always happened. But anyhow, today we're not talking about employment. We're talking about inflation. And, and it is So essentially what I'm saying is that the inflation report went from being kind of important for a while, very important for a while, the only thing we cared about for a while, to suddenly being backbenched. As investors, we should care very much about the inflation report because we only care about real returns. We don't care about nominal returns. And when you have high inflation, it means you've got to have higher nominal returns to make up the same kind of real return. So how do you get higher nominal returns? Well, the best indicator of a future high nominal return is a low starting price. And so historically what happens is that when inflation goes up, and so investors recognize they need to have better nominal returns going forward, asset prices have to adjust to a lower starting price. And so typically that's what happens in higher inflation environments, is you end up with lower asset prices. And so that's why we should care if inflation, in fact, does not continue to decelerate. And it doesn't look like it is going to continue to decelerate. So coming into today's report, the consensus was for 0.33% on headline and 0.31% on core. Now, that's a lot higher than expectations have been recently, and there were all kinds of various reasons for that. And some of it is that people continue to, expect tariffs to come surging through. And they're coming through, but surging is a little strong. They're really going to just sort of trickle in for a while. But people kind of are expecting that. They're expecting rebounds in various parts of the CPI. But the important thing is that there were high expectations and there was a miss on the high side. Now, the miss on the high side wasn't very much, but that's only because the expectations were so high. So headline inflation on a seasonally adjusted basis was 0.38% month on month. Again, expectations were 0.33, and core was 0.346%, expectations for 0.31. Now that 0.346 rounds when they report it to 0.3, and so it looks like it was as expected. But it was very close to rounding up to 0.4%, and I wonder if that had been the headline, if the algos would have been more pessimistic about the result. Markets haven't reacted poorly at all. But again, the fact that this is a small miss doesn't mean it's a small number. In fact, with the exception of the jump in core inflation that we had in January of this year, which was related to tariffs, this is the highest core figure in the last 17 months. So small miss, but not a small number. When we look at median inflation, and again, I say this every month, we don't officially have the median inflation number until usually around lunchtime, but we know enough that we can usually estimate it, and it looks like it will be about the same as last month, 0.276. That's what it was last month, 0.276. And the bottom line is, if you look at the last 12 to 15 months of median inflation, it's all pretty much right about here, 0.3-ish. And so that's kind of where we're settling in, is around 3.5% on median inflation, which is too high. There were a lot of categories that were up on this month. Some people had been expecting medical care to be high, and doctor services was a bit of a gained a little bit, but pharmaceuticals, medicinal drugs, or the medical care commodities fell 0.372% on the month, and that surprises me a little bit. Any one month, who knows, right? But on a year-on-year basis now, medicinal drugs, pharmaceuticals, CPI is down very slightly. It's basically flat. Now, I would have thought, and I do think that over time, the president's attempt to bring down pharmaceutical prices, while laudable, some of the things he has been doing actually will probably have the opposite effect. And so I kind of think pharmaceutical prices will end up being kind of accelerating a little bit more, but at least so far it hasn't happened. And we do have to recognize that I might be wrong on that. Pharmaceutical prices may end up not being the sort of inflationary lift that I had thought. But the important point is that drugs are right now at the low end of core goods. Core goods on a year-on-year basis are up to 1.54%. With the exception of the COVID spike, that's the highest level of core goods inflation since 2012. And again, not entirely unexpected, because while tariffs are not the enormous effect that we were told, and I've talked about that in this podcast quite a bit, any sort of reasonable mathematics tells you it's just not going to be a huge number, because the core goods imports part of the U.S. economy is just not huge. And then there's the whole question of the fact that what we import, a lot of those things tend to be demand elastic sorts of goods, which means that the price does not get passed on very easily to consumers. But when you kind of do that math, you end up thinking that in terms of the total overall inflation, tariffs are not going to be worth more than a few tenths, maybe a 0.5% as a one-time bump, and they'll trickle in over the next 12 months. But that's clearly part of the reason that core year on year is up 1.5%. The important thing to realize is that if core is up at 1.5%, even if it ends up being only 0.75% when the tariffs all wash through, or 0.5%, we're going from a lengthy multi-decade period, really, of core goods being in soft deflation. And that was what allowed us to get to 2% core inflation, is that services ran a little bit hot, but core goods were in deflation, and so that all averaged out. Well, if core goods is going to end up being in inflation of some level, whether it's 1.5%, 1%, 0.5%, then you have to have services being even softer than they were prior to COVID, and that there's no sign of that happening. Right now, core services is up at 3.6% year on year, and it's sort of stopped improving. It has sort of stopped improving. Owner's equivalent rent, which is part of core services, was up 0.38% month on month. Primary rents were up 0.3% month on month. Now, both of those are accelerations from what they were last month, but I don't think that's a real big deal. You'll hear people talk about rents this month as being one of the reasons that we missed, and mathematically that's true. But if you look at the year-on-year figures for both primary rents and owner's equivalent rent, they declined. And what that means is that even with this kind of bump higher this month, what we rolled off from a year ago was higher than that. And so that sort of suggests to me that really this is more of some residual seasonal factor about August that we're just not catching. So rents continue to sort of slide, but they're, again, I say over and over again on this podcast, they are not sliding to zero. I'm not saying that someday they couldn't go to zero, but right now, all the dynamics in the housing market, and we definitely are seeing slowing in housing prices, okay, but rents are more than just housing prices. If you use housing prices to project rents, then you are going to think that we're going to have a significant further slowing. But if you realize that rents are set by landlords and landlords have costs and those costs are rising, then it's really hard to figure out why, especially when there's still a shortage of housing, why you'd see rents be going down, except in some isolated circumstances. And one of the things which might happen is that, if we get rent control in New York under a Mamdani administration, then you could see the overall rent figures look more attractive just simply because we have a large, housing, a large area of housing that suddenly, just by government diktat, has zero inflation. Then you should probably look at rents ex New York in that case, but to see what's really going on. But you could get sort of a mechanical slowing there when that happens. And I say when because it looks like Mamdani right now anyway looks fairly likely to win. But outside of that, and by the way, when that happens, it doesn't really mean that price inflation is lower. It means that what's going to happen is the quality of units will go down quite a bit. And so effectively you're paying the same amount, but you're getting less. So that's inflation. But the BLS doesn't measure the quality of rented units in quite the same way. I'm digressing. But anyway, right now, owner's equivalent rent and rents are tracking right to my model. They're in the threes. They should decelerate a little bit from here, but not a ton. And if you don't have rents decelerating and you have core goods being positive, then you're left with super core and food and energy. But in the core part, you're just left with super core. And super core has lately kind of started flattening out as well to, again, roughly something like 3.6%, 3.5 or 3.6%. So you're kind of running out of things that can get us back to 2%, right? Let me circle back to what I said at the beginning. The Fed doesn't care about getting back to 2%. I mean, they almost have literally said that. They haven't said it in quite so many words, but they've gotten very close to saying that. I mean, they still have an official 2% target, but they don't have a plan for getting there, and they don't really care if they don't get there. There's no plan to make it up if they don't get there. So that's kind of bizarre, and it means that we're likely to end up with higher inflation over time because we have a very dovish central bank. The most important things to the FOMC right now are in order. One, employment. They've said this a number of times. We've recently had weak employment, and we had a massive downward revision to the numbers that came out this week. A massive downward revision to the prior year's worth of numbers that shows that employment was a lot weaker than we thought. That's the first thing the Fed cares about, and that pretty much seals that they're going to do some kind of ease. Two, the second most important thing is politics, and specifically, I mean, jockeying for position for who's going to be the next Fed chair. And we all know that in order to be appointed as the next Fed chair, you better be a dove. If the Trump administration is the one doing the appointing. And so you have Fed officials falling over themselves a little bit, at least the ones who want to be Fed chairman, burnishing their dovish credentials. Again, this is likely to mean an ease or more of an ease than you would otherwise get. The third most important thing to the Fed is their internal modeling about tariffs, their internal modeling about inflation expectations, their internal modeling about rents, and not the actual numbers. Fourth is the actual numbers. The Fed for a long time has ignored the rental data because they're convinced it's going to zero, despite the fact that there's no evidence that it's going to zero. They are convinced that it's going to, and there's also no reasoning that suggests it should go to zero. They believe it. And that matters more to them than the actual numbers showing that it's not actually happening. And somewhere down the list, 35th or so, is the supply of money, which should be higher on the list. and right now is growing at, over the last 6 months, it's growing at roughly a 6% rate, which is kind of where it was pre-COVID. But in the decade or two pre-COVID, we had positive demographics. We had the economy globalizing, right? So we were exporting, or we were exporting production to lower cost countries. Okay. And that had slowed in the last 5 or 10 years, but that had been the trend. And now we're going the other way on both of those things. And so the same monetary playbook that worked when you had good demographics and a good globalization trend is not the same monetary playbook you should be running when you have a bad demographic setup and deglobalization. And yet that's what money is doing right now. Again, it's about the 35th on the list of what the Fed cares about, if it's on the list at all. So if you go through that list, employment, jockeying for a position to be Fed chair, internal modeling, clearly the Fed is going to ease. Now, I will say that a wise Fed chairman would look at inflation steadying around 3.6% on median and say, yeah, we really shouldn't be easing right now. But this is not a wise Fed chairman. And again, the actual inflation numbers are way down on the list of what they care about. I think that the Fed is going to cut 25 basis points, but with some dissents from the more dovish members who are jockeying for position, those dissents in favor of 50 basis points. I would not be at all shocked if the Fed just goes ahead and cuts 50 basis points. It would be stupid to do this with inflation running hot and no clear path for it to decline back to target. But again, the Fed doesn't care about the target. And so we clearly are moving to lower short-term rates over the next 3, 6, 9, 12 months. And to be fair, we are getting more and more signs that we are heading towards a synchronized recession. You know, I've been talking about how the goods and services sectors have been sort of asynchronous, and so we've sort of had this rolling recession where the goods economy was in recession when the services economy wasn't, and vice versa. So that we haven't had this broad recession yet. We're starting to resynchronize, and we're starting to get more indicators that look like that we're going to get an actual recession here. It's not going to be a deep recession by all indications, but it's going to be a recession, and the Fed will respond to that, as they always do, by lowering rates, and probably lowering rates rather significantly. What's not going to happen, what the Fed expects to happen, the reason the Fed thinks they can do this is they believe that if there's a recession, that will automatically lower inflation. It doesn't. There's no evidence of that. There's no history. There's no historical precedent for that happening. And yet that is absolutely in their textbooks. And they completely and utterly believe that if we have a recession, that core inflation will come down. But I think that's maybe a problem for 2026. For now, inflation remains high. It remains in the mid to high threes on a median inflation basis. And the Fed is in easing mode and probably will remain in easing mode for some time. And that's all I have to say about this. That's all for today's podcast. Please like it. Click that little like button or the subscribe button, or both buttons if there are buttons or lists or whatever, and refer other people to this. You can contact me at inflationguy@enduringinvestments.com. You can go read the blog at inflationguy.blog, where, among other things, you'll hear about the USDI coin, the cryptocurrency that is pegged to CPI. You can follow me on Twitter on X @inflation_guy. Visit Enduring Investments if you need help with diagnosing and treating an inflation problem, and most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.